Welcome to the Financial Management Overview webinar. This is a discussion of concepts and calculations in C214 in preparation for the objective assessment. It is a comprehensive webinar. That is, we discuss all the concepts and all the calculations in the course. Many students find the e-text to be a very difficult read and to be overly complicated in some places. So the purpose of this webinar is to produce the course material in a very concise and an easy to understand format. It is synchronized with the e-text. That is, the first session of this webinar will cover sections 1 through 5 in the e-text. Session 2 will cover sections 6 through 9. And finally, the third session will cover the remainder of the e-text. There is also a calculation quiz that is linked to this webinar. And in the webinar, I will explain in great detail exactly how to solve calculation problems. But on the OA, of course, you'll have to solve these problems from scratch. So the calculation quiz has the opportunity for you to solve those from scratch. In the event that you have difficulty solving any of the problems, there is a reference to a slide, a particular slide in this webinar that will explain the calculation to you. The focus of this course is the financial decision-making process for corporations. That is, we take the perspective of a senior financial management of the corporation making decisions regarding the financing of the corporation. In other words, we do not take the perspective of the individual investor buying stocks and bonds, and we do not take the perspective of personal finance dealing with mortgage loans and auto loans. There are three main sections to this course. First, there's financing. That is, we look into funding the operations of the firm with stocks and bonds. That is, corporations sell stocks and bonds to investors in order to raise cash to finance the operations of the firm. In order to do so effectively, we need to understand how prices and yields of stocks and bonds are determined in financial markets. And then finally, overall, combining the cost of stocks and the cost of bonds, determining the overall cost of financing for the firm. The second major area is project evaluation. That is, to evaluate potential investment projects, such as buying a factory or buying new equipment. We'll use two metrics, one called the net present value and the other one called the internal rate of return. Finally, there's the financial forecasting area in which we look at forecasting the funding needs of the corporation. There's a fundamental difference between financial management and accounting. Accounting is fundamentally backward-looking. That is, you're measuring past operations. For instance, in the income statement, you're looking at the results of company operations in the prior year and measuring the success or failure of those operations. Second, tends to be based on historical cost. For instance, when you buy a machine, it is put on the books at a historical cost. It is listed under gross PPE, and that number stays the same. 10 years later, you're still using that same original purchase price for the value of that machine. Third, accounting is based on subjective judgments. One example is when you purchase a machine, you have to estimate the useful life of the machine over which you're going to depreciate it. Is it going to last 10 years or 20 years? That's basically a subjective judgment. Finally, it is accrual accounting, not cash flow. When a product is sold and shipped to the customer, revenue is recognized at that point. When the customer actually pays cash for that product is irrelevant. Financial management, on the other hand, is forward-looking. That is, we focus on executable future transactions. Shall we go out and sell bonds to raise cash tomorrow in order to finance the firm? And it's based on expected future cash flows. It's cash flow oriented, not accrual accounting oriented. And of course, since we're looking at financial markets, it's based on current market values and yields, not on historical values. And finally, it's math-based rather than subjectively based. That is, we calculate the value of cash flows. Now, at this point, perhaps some of you are focused on that word math, and you're worried about this being an overly mathematical course. Let me assure you that it is not. It is no more than perhaps ninth grade math. But of course, unless you're in a greatly accelerated program, it's been a long time since you've been in the ninth grade, and probably few of you sit around solving algebra problems in your spare time for entertainment. So we'll take a very measured, slow approach, and the math will not be a problem in this course whatsoever. Now, there is an article that I found that's relevant to our way we're going to approach this course. And yes, that is the title of it. You are probably not as bad at math as you think. This was written by a math professor who is highly critical of the way math is generally taught, that is, just memorization. And a very good quote from her article is, "Skipping the sense-making step makes for fragile understanding. When somebody only memorizes, every new fact is like an island unto itself and is more readily forgotten." Well, in the context of this course, if you have jumped into the study guide questions and start trying to work your way through those calculation questions, you're skipping the sense-making step. In this webinar, we'll focus primarily and first of all on understanding the logic of finance. There is a basic underlying logic throughout this course that is not terribly complicated, and you'll find out that many of the problems are just using that same logic over and over and over again. Once you understand the context of the problem and the financial principle being used, all of a sudden it's a much easier problem to solve. Then, after you've gone through each of these webinar sessions, then it's when you're ready to take a look at the calculation quiz. Once you understand the logic, then look at the calculation part. So let's look first at section 1 in the e-text, Overview of Financial Markets. The goal of the corporation is to enhance the long-run shareholder value. That is, the value of the common stock owned by the shareholders. It is not simply just maximize profit. In order to do so, it requires that financial decision-making be based on, first of all, current market prices and yields. That is, don't make decisions based on prices and yields in the past. It requires balancing risk and return. That is, not just simply maximize the profit regardless of how much risk you're taking on. You have to balance risk and return. And in order to evaluate investments, you need to use market metrics. As we will see in project evaluation, we're looking to the market to give us signals as to how to evaluate an investment project. Now, the shareholders of a corporation have no day-to-day operational authority or responsibilities. Instead, the managers of the corporation act day-to-day. Managers are supposed to act in the best interest of the shareholders at all times, but managers, being human beings, sometimes act in their self-interest rather than shareholders' interest. That is, they may try to maximize their bonus this year as opposed to looking out for the long-run value of the stock. This is what's called agency cost. And when managers act like this, this reduces the value of the corporation to the owners. Effective decision-making depends on what we call efficient financial markets. An efficient market has 4 basic requirements. First, it has to be competitive. There need to be many buyers and sellers. Second, it needs to be liquid. That is, you can buy and sell very quickly. Third, transparency. You know what bid and ask prices are. You can see them. You see the prices before you execute a transaction. And finally, standardize. There need to be a standard security so that no one buyer or seller can monopolize the market. Now, these are all kind of abstract concepts, so just let's think of efficiency in terms of an everyday market. Let's look at it in terms of buying gas for your car. Is it competitive? Well, there are many buyers. Everyone that owns a car is buying gas. And are there sellers? Well, if you live in an urban area, there are probably many intersections where there are 2 and maybe 3 gas stations on each corner. So yeah, there are many buyers and sellers. Is it liquid? Yeah, you can pretty quickly go in and fill up and leave, so you can buy gas very quickly. Is it transparent? Yeah. All the prices are posted on the pump, but even more important, they're posted on those big signs that you can see from a block away. And finally, is it standardized? Yeah. All gas is basically the same. So buying gas for your car is really a very efficient market. Now, on the other hand, let's compare it to selling a house or buying a house. Is it, can you buy and sell quickly? No, you cannot buy and sell quickly. Is it standardized? No, just every house has something about it that's different. So buying and selling houses is not a very efficient market at all. Now, why is efficient market very important? Well, first of all, when it is efficient, prices reflect the fair value or intrinsic value of the security. By intrinsic value or fair value, we mean just basically what it should be worth. That is, fundamentally, is the price reflect the real value you're getting? Secondly, deviations from fair value are quickly eliminated. Sometimes prices trend a little bit too high, sometimes a little bit too low. In an efficient market, buyers and sellers act to push it back towards intrinsic value. As a result of this, resources in the economy are allocated efficiently, and efficient firms grow because they can attract financing. On the other hand, risky, inefficient firms are restrained. Their cost of financing is very high, and it keeps them from expanding. So the result overall is a more efficient economy. Generally speaking, U.S. financial markets are very efficient with very minimal transaction costs. Let's look at several terms you should be familiar with. First is venture capitalists. Venture capitalists are people who provide equity to new private firms. For instance, if you've seen the TV show Shark Tank, those people are venture capitalists. They will provide a certain stake of money in return for a share of the new company. Next, we have an IPO, or initial public offering. That is a public corporation's initial sale of stock in the market, first time they sell stock. Syndicate, when an investment bank underwrites an issue, it's a risky transaction for them, so they usually form a syndicate or group of investment banks to share the underwriting responsibility. Primary markets, that's a situation when the firm is actually issuing stocks and bonds to be bought by investors, so the corporation receives cash to help fund the operations of the firm. In contrast, the secondary market, stocks and bonds are traded among investors. The firm is not involved at all. The corporation does not raise any cash. Next, we have buybacks. Sometimes corporations buy back its own stock and bonds from investors. That is, it might have issued stock in the past, but for various reasons, it may go out and solicit to buy stocks from investors. In that case, the corporation sends cash to investors. The investors send those securities back to the corporation, who then remove those securities from their balance sheet. We have two types of market. We have auction market. That's where it's very much of a competitive bid-ask situation for many buyers and sellers. That's sort of like stock markets today. And then there's a dealer market. Dealer market is a situation in which a dealer maintains an inventory of securities, and then trades are executed upon investor inquiry. That is, an investor might contact the dealer and might wish to buy or sell a security, and it's a one-on-one transaction with the dealer. Now, sometimes you hear about secondary market trades and buybacks not being desirable. They are very, very desirable because they are essential to create efficient markets. If all we had was primary markets where firms issue stocks and bonds, it would be very inefficient because firms don't issue stocks and bonds all the time. It's like maybe once every 5 years or 10 years. So because of that, the firm would have very little idea exactly what the value of their stock is or the value of their bonds. So secondary market trades and buybacks are really very important to create efficient markets. Now, stock trading, the New York Stock Exchange is actually just one of 13 auction markets for stocks. And the picture on the left is a picture of the New York Stock Exchange trade floor on Wall Street in downtown Manhattan. And this used to be, though, where all the stocks were traded. But anymore, stocks are primarily traded in the picture on your right. This is a picture from ARCA, which is a large computer center out in Mahwah, New Jersey, which is a suburban town about 35 miles north of the New York Stock Exchange trade floor on Wall Street. And that's where most of the trades are executed. ARCA executes some 2 to 3 million trades per day, and each trade is executed in microseconds. So obviously, human beings cannot handle that volume or speed of transaction. So why do we have the New York Stock Exchange trade floor? Well, there is some trading still going on there, not a lot, but mostly it's a PR purpose. Every time you see a story on TV, the reporter likes to stand there on the trade floor and have all that noise and commotion in his background, and it sounds good. It'd be pretty boring if he just stood in front of that computer bank on the right. So that's primarily a PR type thing. But there's really not much trading going on. In fact, some days there's so little activity that they take people out of the back office and tell them to go out and walk around the floor and pretend like they're traders. So it'll be active when the TV cameras start rolling. Now, bond trading is mostly executed in a dealer market. And this is a picture of a typical bond trading floor in New York. And this is a situation where an investor calls a dealer to get a price for the bond that they would like to buy or sell. And generally, an institutional investor would call several dealers to get competitive pricing, make sure they get the best price to buy or to sell. So why is this different? Well, the stocks, all stocks are exactly the same. For instance, a corporation might have 10 million shares of stock outstanding. So when you go to buy a share, it doesn't make any difference whether you get share 1 or share 10 million. It's the same thing. But with bonds, it's quite different. Typically, a corporation has dozens of bonds outstanding. They may have 50, they may have 100, in some cases 200 bonds outstanding. And they're all slightly different in one way or another. So when you go to buy a bond, you have to specify which bond you want. You can't just say, I want the a bond from General Motors. You got to specify exactly which bond you want from General Motors. Let's look next at financial statements, sections 2 and 3 in the e-text. So the Securities and Exchange Commission, the SEC, requires all public corporations, public whether they're for-profit or non-profit, all public corporations have to file audited financial statements with the SEC. This includes the balance sheet, P&L statement, and cash flow, in a format specified by the SEC. Now, this is a really very simplified view of what they file. In reality, these reports, which the SEC calls 10K reports, they are much more involved. In fact, the typical 10K may be several hundred pages long. Now, the SEC also maintains a database called EDGAR that's online at the SEC website that you can get detailed information and copy of any of these 10K reports. There's also a 10Q report, which is the quarterly version of this annual report. Well, let's look at it in a little bit more detail. This is the first of two financial statements that are very, very important for you to master, because what we're learning from this particular balance sheet will be used later on in the course in many different areas. Let's start off at the top, the blue coded area, where we have current assets and current liabilities. This represents the daily operations of the firm. That is, just producing and selling the product. That is, assets, we have cash, accounts receivable, and inventory. For current liabilities, accounts payable, accrued expenses, and notes payable. As you go through the course, though, under current assets, you'll find we're really focusing on accounts receivable and inventory. And on the liability side, we're really just looking at accounts payable and accrued expenses. Now, this does reflect daily operations. So every day, the values of those accounts change. Every time we produce another product to be sold, inventory changes. When we sell a product, inventory declines. If we're selling it for credit, accounts receivable increases. When the corporation receives payment from the customer, accounts receivable goes down. So these items change daily over time. Next, let's look at the lower right, the green shaded area. This is the activity of basically raising cash. It's selling bonds, selling stock to investors in order to raise cash to finance the firm. Now, this occurs infrequently. Firms may sell stock only once every few years or so. Long-term debt, well, it depends on the firm. Some firms may only sell debt a few times a year. Other firms might sell debt several times a month. But it doesn't change daily. It just changes infrequently. Over on the left, lower left, the salmon-colored area is the long-term assets. This is basically buying equipment in order to help us produce the product that we're going to sell to the customer. And under there, we have gross PPE. When we buy the equipment, we basically list that price, that value, as gross PPE. And then each year we have a depreciation expense. Well, if we accumulate all the depreciation year by year, we get accumulated depreciation, and we end up with net PPE. So for instance, let's suppose we bought this machine 2 years ago for $1,200. First thing we do is we've got to put the $1,200 on the balance sheet. It's $1,200. And here we are 2 years later, and that gross PPE is still $1,200. It stays at its historical cost. Then we have to make a judgment. What is the useful life of this equipment? Well, we made the subjective judgment. It's going to last 12 years, so we're going to take $100 of depreciation each year. So I see here that our accumulated depreciation is now $200. Year one, we took $100, and year two, we took another $100. So we have a total accumulated depreciation of $200, which we subtract from gross PPE to get net PPE. Now, there's some relationships on this balance sheet that are very, very important. First, let's look at what's called net working capital. Current assets minus current liabilities. Second very important thing is any increase in an asset, anything on this left-hand side of the balance sheet, if there's an increase in an asset, it's a cash outflow. Contrast, anything on the right-hand side, any increase in liability or equity, that is a cash inflow. Then, what if there's an increase in net working capital? Well, that means that some current assets have increased more than current liabilities. So that means there's a cash outflow that's bigger than a cash inflow. So an increase in net working capital is a cash outflow. It's very important. Remember I said in this course, we don't focus on accrual income. We're really focusing on cash flow. So we'll find later on when we start solving problems, we need to know if these items on the balance sheet change, what is the implication cash flow? Now, one caution to keep in mind, when we say increase in asset is cash outflow, don't try to go through entry by entry and rationalize it as a cash inflow outflow. It can get confusing when you do that, and there's nothing to be gained. All you want to know is anything here increases, it's cash outflow. Same thing on the right-hand side. Don't try to go and rationalize each one of these accounts. It'll get very confusing. Just remember, anything over here that increases is cash inflow. So very important that you understand this balance sheet. Fundamentally, you should be able to take a blank piece of paper and recreate it without looking at this slide. The second one is very important, is the income statement. Now, income statements can be complicated, but this is kind of the setup that's used in this course. We start off, we got sales revenue of 400. We subtract out the cost of goods, which is simply the cost of production. We get gross profit, in this case of 150. And this gives us something we call gross margin. And that is this gross profit of 150 divided by the sales of 400. Next, we subtract operating expenses and depreciation, and we get something called EBIT, earnings before interest and taxes. And we use EBIT to define operating margin, which is EBIT divided by sales. It's $80 of EBIT divided by the 400 sales rate. Next, we subtract interest and we subtract taxes to get net income. Net income is used to define net margin being net income divided by sales. Now, there are three very, very important relationships that you need to remember. The three in red. Net margin is net income divided by sales. Okay. Then net income. Anytime you have net income, it goes to one of two sources. Pay out dividends. Anything not paid out in dividends is added to retained earnings. Finally, the payout ratio, simply the dividends paid divided by net income. Now, these formulas are given to you in the sidebar in the OA, but if you have to go and look to find out the meaning of this, you're really just not going to be able to solve the problem on the OA. You need to just inherently know that. Now, there is a connection, two connections back to the balance sheet. First is this depreciation, that every year we take some depreciation expense and you go back and you add that to accumulated depreciation over here. So accumulated depreciation, we just every year we add more and more to it as we take the depreciation expense each year. Next is this retained earnings. Each year, whatever we don't pay out in dividends, we add to retained earnings on the balance sheet. So we come back over here. Perhaps this should be called accumulated retained earnings, because that's basically what it is. Year after year, we're adding to that. So this is a basic income statement as used in this course. Very, very important that you be able to understand this and use this in other types of problems. There are actually two types of income statements. The income statement for the SEC must follow GAAP, generally accepted accounting principles, but income for tax purposes follows IRS rules. And generally, IRS rules allow more depreciation expense and therefore reduced taxes. So let's look at a couple of problems that we might solve based on net income. So the firm has $600 in sales, operating expenses of $300, depreciation expense of $100, and a 25% tax rate. What is net income? Sales minus operating expense minus depreciation gives us EBIT minus the taxes at a 25% rate. So 25% of the 200 is 50, and we get net income of 150. Well, if the payout ratio is 40%, how much is added to retained earnings? Well, payout ratio, we know its payout ratio is dividends paid divided by net income. So if we multiply that 40% ratio times net income, we find out that $60 is paid in dividends. So what's left over is added to retained earnings. So we took our net income of 150, subtracted out the dividends of 60, we find out we've added $90 to retained earnings. So you're very likely to get a problem like this on the OA. Let's change it a little bit. Let's talk about solving for cash flow. We've got the same firm, same sales, same expenses, same tax rate. So all the calculations are the same until we get down here to net income. And of course, we got the same net income as we had in the previous slide. But if we're looking for cash flow, depreciation is not a cash expense. It's just a made-up accounting number. Remember we said we bought that machine for $1,200 on my balance sheet. We just guessed it had a 12-year life. We're just going to deduct $100 depreciation each year. That's an accounting number. It's not actually cash that goes out the door. So when we get down to this net income of 150, we need to add depreciation back in to get cash flow. Think of it this way. Suppose you're just think of a big cash register as the firm, and this cash register is empty until all of a sudden the salespeople come over and they give you $600 in the cash register, and so that's there. Then the operating people, production people come over and they say, well, we need $300 cash paid for materials, paid for labor, and so forth. All right, so you pay out that 300, you only have $300 left in the cash register. Then the tax people come by and they say, we need $50. I'll say, so you give them $50. So you got $250 in the cash register. And you're like, well, I haven't talked to the accountants about depreciation. So you contact them and they say, well, we don't need any cash. You know, it's a non-cash item. So you get to keep that $250 in the cash register. So we deducted it up here. We had to add it back in. Now, important thing is, remember, again, finance is very cash flow oriented, and that's why we're looking at this cash flow right now. Now, a bit more complicated one. Indeed, this is on the a version of this on the pre-assessment. Suppose a firm has $1 million in sales, net margin 25%, payout ratio of 20%. What's the addition to retained earnings? Okay, now if we didn't know that net income is divvied up between dividends and addition to retained earnings, we might not know how to even start to solve this problem. And although, again, these formulas are given in the sidebar, if you have to look it up, you're not going to solve this problem. So we know that net income equals dividends plus addition to retained earnings. So first thing is, well, we need to figure out what net income is. Well, we know net margin is net income divided by sales. So 25% times the million in sales gives us 250,000 net income. We know that the payout ratio is dividends divided by net income. So 20% times our net income. We paid out $50,000 in dividends. So what's addition to retained earnings? Well, it's that 250,000 income minus the dividends we paid out leaves us with $200,000. So again, net margin, payout ratio, allocation of net income. Those are the three items that are very important for you to know that and not have to look it up to solve the problem. Next, let's look at statement of cash flows. There are three categories or sections to the statement of cash flows. Something called cash flow operations, cash flow from investment, and cash flow from finance. Let's look at a color-coded version of the balance sheet and income statement so that we can kind of figure out, well, where does all this come from? How do we define these three categories? First, let's start with CFO. Cash flow operations reflects basically daily operations. Well, when we say we do daily, we produce the product and we sell the product. We create net income. So the first part of this is net income. But again, we're talking about cash flow, and we know that net income is not the whole story. We have to add depreciation back to it. Like a couple slides ago, when we're looking at calculating net cash flow, we've got to take net income, we've got to add depreciation. Now, there's one more component. Since all these current assets and current liabilities change daily, and as we saw before, current assets increase, cash outflow, current liabilities increase, cash inflow. Well, we know changes in these items affect cash flow. So these three blue areas are what we look for in cash flow operations. Now, cash flow financing, raising of cash, again, selling bonds, selling stock. We sell those to investors, they send us cash. So that's cash flow into the corporation. Of course, if bonds mature and long-term debt decreases, that's cash going back out. And of course, if we pay dividends to shareholders, that's an outflow of cash. Over here, salmon area, again, we're looking at gross PPE, accumulated depreciation. We're really looking at if we go out and buy equipment, if we buy new equipment, that means we're sending cash out the door to pay for that equipment. So, and again, it's this asset increases, cash flow is going out. So let's look at each of these. Now, you'll notice in the upper right-hand corner, it says this formula is not provided on the OA. Well, the three statements of cash flows are not, the formulas are not provided, so you'll need to remember. And later on in the course, near the end of the course, I'll show you that there are three others that you will need to remember. So first of all, cash flow operation is cash earned by producing and selling the product. Okay, here we are again. Remember, cash flow, net income. You have to add in depreciation expense because that's that non-cash item that we subtracted in order to calculate net income. And we know that if net working capital increases, that's a cash outflow. So we have to subtract any increase in net working capital. Again, remember, net working capital is current assets minus current liabilities. Let's look at an example. Net income is 300. Depreciation is $1 million. Net working capital increases by 300,000. So 3 plus 1 minus 0.3. We have cash flow operations of 3.7 million. Now, again, this is like core operations of the firm. So stock analysts often focus on cash flow operations as an indicator of the success of the core business of the company. That is, are they selling products or not? Are they generating cash from selling products? That's fundamentally the most important thing they look at before getting into different financial issues. Next, look at cash flow from investment. This is cash spent for investment projects. So fundamentally, it's a cash outflow. Now, the easiest way is just simply, if you're given the change in gross PPE, you've got the answer without really any calculations. So gross PPE increased by $1 million. You bought $1 million of machines. You had to send $1 million out the door. So we multiply by -1 because if gross PPE increases, that's cash outflow. Now, could be, though, that you're not given the change in gross PPE. It might be that you're only given net PPE and depreciation expense. Okay, let's go back. Remember, on the balance sheet, gross PPE equals net PPE plus accumulated depreciation. It's just that salmon area in the lower quadrant of the balance sheet, lower left quadrant. So if we're looking for the change in gross PPE, it's equal to the change in net PPE plus the change in accumulated depreciation, which means it's this year's depreciation expense is the change in accumulated depreciation. So it's gross equals net plus depreciation. So change in net PPE plus depreciation equals the change in gross PPE. Well, let's look at an example. If we had gross PPE end of 2017, it was 500 on the balance sheet. In 2018, it increased to 525. So there's a change in gross PPE of 25. That means we bought $25 of equipment. So we bought it, we multiply by 25, we'll know that we'll have a $25 cash outflow. Well, let's look at it from the net PPE category. So net PPE at the end of 2017 was 400. End of 2018, it's 405. So net PPE increased by 5. Okay, we've got that part, the change in net PPE. Now, let's look at accumulated depreciation. It was 100 in the end of 2017, 120 at the end of 2018. So it increased by 20. In other words, depreciation expense in 2018 was $20. So we're going to take the change in net plus the change in accumulated depreciation or depreciation expense, and we find out it's $25. Of course, it's cash outflow, so it's a negative number. Third, let's look at cash flow financing. This is cash raised by buying and selling bonds. So, and its definition is the net increase in stock plus the increase in bonds minus dividends paid. So when we increase stock, we increase bonds, we're on a net basis selling securities to investors, and they are giving the corporation cash, so that's cash inflow. On the other hand, pay dividends, that's cash going out the door. So simple example, stock increases by 50, debt increases by 200, dividend paid 25. So end up with cash flow financing $225,000. So at this point, of course, we're really just talking about what is cash flow financing? What is this dollar amount? As we go through, though, we're going to address much more fundamental problems, and that is, what is the cost of selling debt and equity? How much does it cost the corporation to induce investors to buy those securities? And then, well, what is the proportion of debt and equity? Should it be mostly debt or mostly equity? So those will be two very important questions that we'll be addressing later in the course. Next, let's look at financial ratios, which is section 4 in the e-text. There are 4 general categories of financial ratios: liquidity, efficiency, financing, and profitability. Liquidity basically is measuring the bill-paying capacity of the corporation. They're going to have enough funds on hand to meet all their bills. The 2 most important ratios are the current ratio, which is defined as current assets divided by current liabilities, and the quick ratio, which is current assets minus inventory divided by current liabilities. Again, looking at it from the point of view of bill-paying capacity of the corporation, and generally investors and creditors would like to see that those ratios be fairly high, indicating an ability of the corporation to pay all its bills. Next, we have the efficiency, which is sort of asset productivity. There's the asset turnover ratio, which is the ratio of sales to assets. And there's a fixed asset turnover ratio, which is the ratio of sales to fixed assets. So the whole idea is you want to get maximum sales from whatever assets you have. Remember, whatever assets are on the left-hand side, you're going to have to finance it by selling stocks and bonds, and that financing has a cost. And so the more you have to finance, the more your expenses. Next, we have financing ratios. That measures the degree in which you rely on debt versus equity. So the debt ratio is liabilities divided by assets, and financial leverage ratio is assets divided by equity. Again, later on in the course, we'll get into the implications of having mostly debt or mostly equity. Finally, there's profitability. 2 main ones: return on equity, return on assets. Return on equity is fundamentally the most important one. It measures net income divided by equity, and you could think of it as, in an accounting measurement sense, the return provided to the shareholders. Because the shareholders have invested equity, that's their investment. Net income, that's their earnings on that equity. So if the ROE is 25%, the shareholders are earning 25% in an accounting sense. Another one is return on assets, which is just net income divided by assets. And sometimes that's used just to abstract from the degree of equity and debt financing. Overall, these are very rough, simplified approach to evaluating firm performance. There's nothing official about it. It's not GAAP. You can make up your own ratio if you want. And often the interpretation is somewhat iffy. For instance, let's look at the efficiency ratio. Let's look at fixed asset turnover ratio. So let's suppose we have 2 firms. One firm produces its product solely with manual labor, and about all they have is a big factory. So their ratio of sales to fixed assets would be very high, which generally is interpreted as good. On the other hand, though, a competitor, a direct competitor, produces the same product, but they have a very highly mechanized operation. They use robots for everything. Now, those robots are listed on the balance sheet as fixed assets, whereas labor is not. So their fixed asset turnover ratio would be much lower. Does that mean it's less efficient firm? Yeah, could be. It's a lot more efficient than the firm that uses only labor. So again, it's just a very rough approach, and really it's kind of the first step in going into a more deeper analysis. Now, there are 2 main types of analysis, or actually 3. Trend analysis compares the ratios for a single firm over time. In other words, we might look at the current ratio in 2016, 2017, 2018 and see, is it increasing or decreasing, and what does that mean? Then there's cross-sectional. That's when you compare a firm to its competitor, or you're comparing a firm to the industry average. And finally, there's goal monitoring. Often, corporations will use uh, various financial ratios for performance goals, such as meeting a certain operating expense ratio or meeting the return on equity ratio. Now, there are several pitfalls. First are timing issues. The fiscal years of firms may differ. One firm may use a calendar year for their fiscal year. Another firm might use, say, July to July. And so trying to compare firms with different fiscal years may cause problems. Seasonal. Many firms have seasonal sales, so the time of year you pick to measure it has an impact. Accounting. Well, accounting methods may differ. For instance, in financial institutions, some institutions, all of their security investments, they keep on their books at the original purchase price. Other banks have or keep the value of their on their balance sheet. They use the current market value of those securities, and that market value increases and decreases over time. So it's hard to compare those. And finally, cross section. It really is very, very difficult to measure ratios across different industries. For instance, trying to compare an auto manufacturer to a grocery chain would be not very useful. So again, ratio analysis is just a rough tool. It's the first step in a deeper analysis. Finally, section 5, we're actually starting finance for the first time. We're getting away from accounting. Now, it's all based on what's called the time value of money. And the time value of money principle is the value of money depends on when you receive it. Now, let's start with the first question. Would you prefer to receive $100,000 today or a year from now? That's a pretty easy question. I'm not sure why anybody would want to wait a year when they can get the 100,000 today. But now let's complicate it a little bit and say, by how much? Would you prefer to receive $90,000 today or $100,000 a year from now? That gets a little bit more complicated. Different individuals would come up with a different answer because individuals are using a variety of criteria for making that decision. Now, in financial markets, though, the interest rate is used to determine how much. So, three key definitions. Present value, that's the value of cash today. In other words, getting that $90,000 today, or in the first question, $100,000, is the value of receiving the cash today. Future value is the value of cash that you receive sometime out in the future, a year from now, 10 years from now. Interest rate is a metric that translates between PV and FV. So let's see what we mean by translates between the two. So suppose you deposit $100 in savings account that earns 5% interest at the end of the year. How much money would you have after a year? Well, you've got $100, and if you have 5% interest, that means you're going to earn $5 interest on that. You have $105 at the end of the year. Or, you multiply by 1.05 to get 105. The 1 is your original $100 that you keep. The 0.05 is the interest, and you get 105. Or generally speaking, we could just say present value multiplied by 1 plus the interest rate gives us future value. So in that sense, this interest rate translates PV into FV. Well, we can go in the opposite direction. What is the present value equivalent of future value? If you receive $105 in 1 year, what is the dollar amount? What is the value today? Well, we do the opposite. We take $105, we divide by 1.05, we get $100. Or generally speaking, take future value, divide by 1 plus the interest rate, we get present value. So again, that interest rate is translating future value into present value. So this TVM logic is really a simple logic that underlies everything in this course. If we want to convert PV to future value, we multiply by 1 plus the interest rate. If we want to convert future value to present value, we divide by 1 plus the interest rate. We'll find out when we go to value stocks and bonds, figure out what their market prices are. The analysis is simply the repetitive application of these relationships. So that's the simple logic that underlying so much of what we look at in this course. So let's look at some time value of money problems. First, quick look again at calculator. Of course, the TI-BA2 Plus is the recommended calculator and the one that's supported in this course by all professors. So first thing you want to do is you want to make sure that you've set the decimal places so that you have 4 decimal places. So if you only see 2 after the decimal, you just go in, you say second, and you come down here, hit format, and then you do, then you type 4, and then hit enter, turn it off, turn it on, and you should see the zeros. Now, a lot of the problems, all the complicated problems we use, we're going to use these 5 white financial function keys. Now, anytime you use that, you're going to be storing numbers down inside the calculator. So before and after you solve any problem that uses these white keys, you want to make sure that your calculator is cleared. To do that, you need to do second, clear work, second, clear TVM. And hit clear entry, turn it off, turn it on, and you're ready to go. Before and after every problem. It's very easy to forget to do that. When you do, you're not going to get that next problem. Now, there is one weird problem that you have to change the mode of the calculator. And we'll talk about what that means a little bit later. But your calculator is automatically in the in mode. And fundamentally, that is just that you're receiving cash at the end of each period. Now, there is a weird problem, the 1 out of 100 in this course, that uses begin mode. By begin, we mean cash is received at the beginning of each period. Well, to convert to a begin mode, we want to hit the second key, and we'll want to come over here, literally hit that white payment key, which is begin. And we'll hit second, and we'll come up here and set, and we're going to enter that, turn it off and turn it on. When we do that, we should see the word begin right above those zeros. That means we're in begin mode. Now, once you do that and solve a problem, you want to always, the first thing you do is change your calculator back to the in mode, because practically every problem is in mode. So we use the exact same keystrokes. We're going to do second, again, second, set, turn it off, turn it on. And now you should see just the zeros. You shouldn't see that begin. There's one other thing, but this last clearing you won't get to much later in the course, and we'll talk about it when we get to it. Now, what are these 5 white keys? First, N is the number of payment periods. IY, interest rate per payment period. PV, as we said before, is the present value of cash today. Payment is the dollar payment made per payment period. And FV, future value of cash, the value of cash received next year or 2 years from now. Now, note that N, IY, and payment are in terms of per payment period. Now, it may be years, but it may not be. In other words, if I said it was a 5-year investment, didn't say anything differently, you might interpret N as being 5. But if I said there's a bond that's 5 years, but it makes 2 interest payments per year, well, then you'd have 10 payment periods because you'd receive 10 interest payments over the 5-year life of that bond. So another way to look at it, present value is a single lump of cash today. Future value is a single lump of cash received sometime in the future. Now here's the difference. Payment is a series of lumps of cash. That is, you're receiving a lump of cash each period for a number of periods. 5 periods, 10 periods, 20 periods. How many periods? N is the number of payment periods. So if you receive 2 payments per year for 5 years, you have 10 payment periods. Yield, yeah, it's the yield per payment period. So the important thing, all three of these, they're not necessarily years. And if they're not years, you're going to have to make some adjustments. Now, all the time value of money problems, you're going to receive information about 3 of these, and you're going to have to solve for 4th. So there'll be one that you don't use. Now, later on, we get to chapter 6 in the e-text talking about bond valuation. Then you'll use all 5. But the time value of money, generally, you just don't use. We get inputs on 3 and you solve for 4. So let's look at a simple problem. Time value of money, problem number 1. If $1,000 is invested today that earns 5% interest, what is the dollar value of that investment in 10 years? Okay, first thing you do is just go through and try to identify what each of these are in terms of those 5 white keys. So we have $1,000 invested today. Okay, that's a single lump of cash in hand today. That's PV. So we'll come over here. These are the exact calculated keystrokes that we'll use. We'll type in 1,000, and we'll hit that PV key. Next, it says we're going to earn 5% interest. Okay, so that's the yield per period that we're earning. So we're going to, that's 5. 5 is IY. So note though, we're entering 5 as a number. We do not put 5%. We do not put 0.05. It's just 5 and then IY. Next, the number of periods, well, 10 years. So number of periods is 10. So 10 is in. And we want to know what is the dollar value of the investment in 10 years. So what is that single lump of cash balance out there 10 years from now? Well, that's future value. So we want to hit the compute key, FV. We'll find the number that says 1,629. Now at this point, you might notice that you have a negative number on your calculator. Well, in this case, just ignore that negative sign. It's just due to the way the calculator is constructed. And later on, we'll get into why that is so. So we're going to compute. So at the end of 10 years, we'll have $1,629. 1,000 of that represents our original investment. 629 is the number of dollars of interest. So how did we get there? Well, end of year 1, well, we had $1,000 sitting in our account all year. So at the end of the year, we earned interest at 5%. So at the end of the year, we're going to have $1,050. So then during the year 2, we have $1,050 in there. End of the year, we're going to earn interest, so we're up to $1,103. Then we're up to $1,159. You notice what we're doing. We're multiplying by 1 plus the interest rate. We're multiplying by 1 plus the interest rate. Multiplying by 1 plus the interest rate. Again, there's that time value of money relationship, which we're shooting for future value. We just keep multiplying by 1 plus the interest rate. Now, this could be a long, tedious process. Suppose you had a 30-year investment. You don't want to have to go through and multiply that. Luckily, that's where the calculator comes in. We hit that compute key and it just automatically starts multiplying by 1 plus the interest rate sufficient number. Now, this is all just an annual problem. Earn 5% into each year. What if I tell you we're going to make the interest payments semi-annually? So what if it's $1,000 we invest today with a 5% yield paid semi-annually for 10 years? Well, we're getting 2 payments per year. It's 10 years. Okay, the number of our payment periods, we got 20 payment periods. So we got to change n to 20. And so what is our yield per payment period? Remember, IY is the yield per period. Well, if we're getting 5 per year, then we're getting paid 2.5% each 6 months. So IY is 2.5, and then we calculate future value, and we find out it's 1,639, a little bit more than we did before. Why? Well, we're earning interest on interest because we're getting paid semi-annually rather than annually. Well, Instead of receiving $1,000 once, let's receive $1,000 at the end of each year for 10 years. It's going to earn 5% interest. We want to know how much money will we have in 10 years. So this is what's called an ordinary annuity, and that is the payments received at the end of the period. Now, again, just about everything in finance is end of period. The next slide we'll look at is the odd guy that's beginning of the period. So how we do the calculations, it's pretty much the same. We have $1,000, but since we're receiving it year after year after year, that's a series of lumps of cash. It's no longer present value, it's payment. So our first step, 1,000, hit the payment key. That same 5% yield, so 5 is IY, still have 10 years, so 10 is in. I'm going to compute future value, and I'll find out I got 12,578. And again, ignore the negatives. Where'd that come from? Well, 10,000 of that is $1,000 received each year, and the other, the 2,578, that's the interest accumulated. So, how did this work out? Well, okay, year one, we didn't receive that $1,000 to the end of the year, so we don't earn any interest year one. So year two, well, we've had $1,000 in our account all during the year during year two, so I'm going to multiply by 1 plus the interest rate, and I'm going to get a balance of $1,050, and then I'm going to receive another $1,000 deposit. So I'm going to have $2,050 in the year, and so forth. Again, what are we doing? We're multiplying by 1 plus the interest rate. We're multiplying by 1 plus the interest rate. That's the beauty of the calculator. It's going to do all the repetitive multiplication for us. Now, what if it was not an annual pay? Again, let's look at the semi-annual alternative. Suppose instead of 1,000 a year, our payment is 500 every 6 months, and the yield is paid semi-annually and a 10-year term. Okay, semi-annual, we've got to have an adjustment to payment, to N and IY. Well, we've given the adjustment. The payment is $500 every 6 months. N, well, we've got 2 payments per year for 10 years, so N is 20. And IY, again, if it's 5% yield, we're going to earn 2.5% each. And we calculate then the future value. So again, payment in IY, it's not annual. You've got to make an adjustment to those three. You never have to make an adjustment to PV or FV. All right, now we've got the odd one, something called annuity due. And that's where you assume that the payments are received at the beginning of each period. Now, it's odd enough that when you try to identify whether it's an annuity due problem, you always look for the word beginning in the question. Here, the question is, 1,000 is received at the beginning of each year for 10 years. It earns 5% interest. What's the dollar value in 10 years? The key, beginning. Once we do that, first thing we do is we just change our calculator to begin mode. We went through that 4-key sequence. Once we do that, these keystrokes are exactly the same as in the previous problem, the ordinary annuity. 1,000 is payment, 5 is outright, 10 is in. We don't have to change anything. Calculator knows by going to begin mode that the cash is received at the beginning of the year. And we compute future value, 13,207. What's the calculator doing again? Again, multiply by 1 plus the interest rate, 1 plus the interest rate, so forth. Now, every time you solve one of these problems, the first thing you should do is go back and change your calculator back to the end mode. It's very easy to forget. If you do, you're going to miss all the subsequent problems. So always change it back. Now, actually, there's another way of doing that. There is a shortcut. You could just leave your calculator in the end mode, and then when you solve for future value, multiply by 1 plus the interest rate. Okay? So problem 2, it was identical, except it was end of period. We solved for the future value, and we found that it was 12,578. Well, I could just multiply by 1 plus the interest rate, and I get that 13,207. So what is the difference? It's just down to with an annuity due, you receive cash sooner, and therefore, if you receive cash sooner, it's worth more. Next, we have valuation of a perpetual annuity. Now, this one we do not use the 5 white keys. It's a very simple thing. The present value of an endless stream of payments, simply that payment each year or whatever period, divided by the interest rate. So let's assume that we have a $100 payment per year forever with a 10% interest rate. How you solve this? It's the present value divided by 0.10 gives us $1,000. So a very simple item. Now, this seems like kind of a theoretical thing because forever is really quite a long time, but it's just a mathematical framework. And later on, when we talk about corporations selling stock in order to raise cash, there are actually two types of stock, preferred stock and common stock. Preferred stock is one that has a fixed dollar dividend, $100 a year, and has no maturity date. So theoretically, it never matures. So uh, this type of arithmetic is used to value preferred stock. Next, we have a growth perpetual annuity. It's almost the same thing. It's in the stream of payment, but the payments increase each year. So it's slightly different. We just take that first payment, we divide by the interest rate minus the growth rate. So, for instance, if we have a $100 payment that goes by 3% a year and have a 10% interest rate, just the $100 divided by 0.1 minus 0.03. In other words, $100 divided by 0.07 equals 1,428. Now, the reason that we have this type of analysis, it's used for common stock. Because like preferred stock, common stock has no maturity date, but instead of a fixed dividend, the dividend is assumed to grow over time. That is, over time, the corporation becomes profitable, expands, they make more and more money, and then they increase their dividend over time and returning cash to the investor. Next, we have the dreaded two-step problem. These problems are difficult, but it's two fairly straightforward, simple problems that are lumped together to make one problem. And that becomes a difficult. So let's look at this. It says a person wants to have a $50,000 annual pension payable at the beginning of the year for 10 years. Assuming 20 years to retirement at 7% interest rate, how much should be saved each year from that year-end bonus? Well, in all of these, step one is like out in the future. It's like trying to establish a financial goal out in the future. So we want to have $50,000 payable for 10 years. So, what are we looking for? We're looking for present value, we're looking for future value. Okay, so let's look at it this way. Step one is how much savings do we need to fund that pension? How much cash do I need in 2039 that can fund that 50,000 a year from 2039 through 2040? Well, simplest way not to get confused is just mentally put yourself in the time machine and let's move forward. We're no longer in 2019. We're out in 2039 and saying, all right, here I am, January 1, 2039. I want to know how much money do I need in my savings account that I can pull out $50,000 a year for 10 years. Now, if I earn zero interest, that'd be pretty simple. I need $500,000, and I could take 50,000 out each year for 10 years, and 500,000 be enough. But since I earn interest, I know I don't need 500,000. So I want to figure out what I need. Well, first of all, the pension will be beginning of the year, payable at the beginning of the year. So we have to change our calculator to begin mode. We want to get 50,000 year after year after year. So it's a series of lumps of cash. So that's payment. How many years? 10 years. So 10 is in. IY is 7. Now, what are we going to compute? We're standing out there in January 2039. I want to know what's the present value of that $50,000 a year. I want to compute present value. I want $375,762 in my savings account January 1, 2039. That'll be enough so that I can pull out $50,000 each year from my savings account. And when I pull the last $50,000 out in 2048, I'll have zero left. Okay, so that's what we need. So step two, let's go back and says, how much do we need to save per year to accumulate that? Well, step two, let's come on back to the present. We're back in 2019, and we're saying, I need $375,000 in my savings account at the beginning of 2039. And I'm going to save my year-end bonus to get there. All right, year-end, first thing we want to do, well, first thing we want to do is we want to clear our calculator. Because when we solved all this and we got this 375,000, there's a number stuck down in the registers. So we want to clear the calculator. Now, it's easy to remember to clear a calculator after a problem, but when you have a two-step, you got to clear it after you finish step one. So we cleared it. Then we changed the calculator to in mode. And now that 375,000, I'm sitting here in 2019, 375,000 is what I want in 2039. That's future value. I got 20 years to save up. 7% is my interest rate. And I want to compute how much I save each year. Okay, a series of lumps of cash, period after period after period. So I'm going to compute payment. And I need 9,166 as my savings out of each year's bonus. So each year for 20 years, if I deposit $9,166 in my savings account to earn 7% interest, come January 1, 2039, I'll have $375,762 sitting there. And then I will immediately take $50,000 out for my first year's pension. And when I get down to January 1, 2048, I'm going to have exactly $50,000 in that account. I'm going to pull it out for my 2048 pension payment, and I'll have zero left in my savings account. So all of these two-step problems, just think about it that step one is inevitably kind of out in the future, establishing a financial goal in the future. Step two is coming back to the present and figuring out, how do I hit that future financial goal? One word of caution, most of the problems we've been practicing on and in the study guide, it's a combination of begin mode and end mode, but that's not necessary. It could be both steps are in mode. Again, you want to always look, if you see beginning of the year, that's begin mode. If you don't, it's always in mode. So that's the end of session one. This time, please go and work on section one in the overview calculation quiz. That will test your ability to solve from scratch the problems that we talked about in this webinar. For instance, question one is this, and in the calculation quiz, I'll give you the answer, numerical answer, 37.5. First, you have to figure out how to get to that 37.5. Should you struggle, have a problem, every question, there's a slide reference. Go to slide 15, I'll explain to you how to solve this problem. So, any suggestions or questions you have, please feel free to shoot me an email if it's a quick question. If it's something more difficult, you could schedule a call. But I do recommend, if you have a question, send it directly to me at my email, as opposed to posting it in a community chat. In the community area, it might take a couple of days for you to get an answer. If you send it directly to me, I can give you an answer much quicker. So thank you for joining this session of the overview webinar, and hopefully you will join next time.